You've probably heard about the financial crisis of 2008 and might have even lived through it. If you died, well, I guess you don't care about the story. But this story gets deeper the more you realize. So today we're going to take a hard look at the crash and the effects we're still feeling today. Let's get it.
I'm not a financial advisor.
Oh, no, I don't go there pretty much because that's hard. I mean, you can talk about, I talk about the economy and the idea of like the new...
About the Wall Street people.
Oh, yeah.
You can give them a huge hard time.
I talk to them about being like a group of junkies who've relapsed, going, listen, man, I just need some liquidity, you know what I'm saying? I just ran into some bad subprime, you know? We just had complex formulas. We just didn't factor in greed and panic, you know? I just need $805 billion by Tuesday. Yeah, no, seriously. No, I would not screw you again. It's pretty crazy.
I learned my lesson.
No, baby, this is not like the other time. Seriously, just throw me a bad here, baby. Help me out.
Just give me a little bit.
Yeah, just a taste. That's all I need is a taste. I need $2.5 trillion. I'll pay you back.
Get me through 1 week.
Yeah, it's like they're going to print out a new $20 bill. The new Geithner $20 bill will be, instead of "In God We Trust," it'll just say, "Trust me." And it'll be the little man from Monopoly going like that.
Welcome to the channel. I'm your host, the BitBoy. And today we're getting deep. If you want to increase your political, historical, and financial IQs, make sure to watch this entire video and smash the like button. Your IQ will not go up unless you hit that button. Financial crisis of 2008 was a much bigger deal than most people realize, and it really doesn't get the attention that it deserves. The crash and the events surrounding it had massive ripple effects that we are still feeling today in economics, politics, and even crypto. The first signs of trouble, they were there in 2007, but the roots of the crisis go back much further. And it all started with a scam that the banks were running called subprime mortgages. These were mortgages that should have never been granted in the first place, but they were modified in a few different ways because the banks that were giving these loans were rushing to capture as much of the market as they could. When someone applied for a mortgage and they didn't have a lot of assets or a large income, the banks would consider them high-risk buyers, and their mortgages would have higher interest rates than the average buyer. People who signed into subprime mortgages to buy a house probably knew that they were punching a bit above their weight with the mortgage, but thought that they would be able to make up the difference over time. Many of them probably would have actually been able to pay off the mortgages if the terms remained the same, but that's not how it worked. The interest rates weren't only high, they were adjustable, which meant the banks could drastically increase the payments without any warning. And that's exactly what they did. So people started losing their houses. Millions of people ended up losing their homes over this, and some of them were never able to get back on their feet. Homelessness has always been a problem in this country, but the tent cities across nearly every major city is a trend that began with this crash. Millions of people losing their homes is already a massive crime. But it gets a lot worse than that because those mortgages were tied to the global economy. So the collapse of those mortgages disrupted markets all over the world. The contagion was caused by a financial instrument called mortgage-backed securities, which were bundles of mortgages that were traded on the market. Buyers of these securities were basically buying a share of the principal and interest payments from a pool of mortgages. In the case of subprime mortgage-backed securities, they were usually pooled together, which made them even more risky. If you're watching this video, you probably know one of the most important things about risk, and that's the fact that bigger risk will often lead to bigger rewards. And these mortgage-backed securities, they were no different. They were like meme coins or algorithmic stable coins of the traditional finance world at the time, and they were extremely profitable for many years. This all caused a massive bubble in the housing market, and it probably would have crashed much earlier if it wasn't for another financial instrument called credit default swaps. This technique was invented by JP Morgan Chase, and I talked a bit about their involvement in the crash in my 3-part video series on the Morgan banking dynasty. Check that link out above. These swaps allowed hedge funds, banks, and insurance companies to trade the risk that these mortgages represented, which added even more fuel to the fire and made the contagion even worse.
You start off very simply here. You take a bunch of mortgages here, okay? Joe, Fred, Jane, okay? They're $100,000, $200,000, $300,000 mortgage. You put it into one big thing. We call it a mortgage-backed security. Say it's $50 million worth, okay? That's step one. We got more to go here.
I'm with you.
You're with me on this.
This is the easy part.
That's the easy part, okay? Now, you take a bunch of these mortgage-backed securities and you put it into one very big thing. You see, that's a $50 million piece, that's a $50 million piece. The one thing about all these guys here is they're all subprime borrowers. Their credit is bad, or there's something about it that doesn't make it prime, okay?
All of them.
Right, now watch, interesting thing we're gonna do here is, remember, these are subprime credits, right?
Yes, yes.
We're gonna make some AAA paper out of this. Well, you just watch. We're gonna make some good paper. So now we have this thing here, a $1 billion vehicle here, right?
Okay.
Now's the tricky part, because what we're going to do is we're going to slice it up into 5 different pieces.
Got
okay? 5 different pieces. Call them tranches, call them levels, call them what you will. But the key here is they're not divided by Jane's is here and Joe's is here, right? Jane is actually in all 5 pieces here. Why? Because what we're doing here is your BBB minus tranche here. They're going to take the first losses from whoever is in the pool. Somebody stops paying, okay, all the way up to about 8% of the losses these guys are assuming. So what they're saying is, look, you got it, you got losses in your thing, I will absorb those losses and pay you for them. In return, you're going to pay me a relatively high interest rate. All the way up to AAA, where 24% of the losses are below them, okay? So the whole 24% of it has to go bad before they see any losses, and they get, you will see, a relatively low interest rate. Now, what is AAA paper? Right. Here's what we've done. Here's the magic of this as far as the Wall Street's concerned. We have taken subprime paper and created GE quality paper out of this, okay? We have a AAA tranche here, okay? Now, we're going to show how it's blown up here. Here's a little nuclear bomb action there, okay? Here's the issue when it was issued. Your AAA paper had a yield of about 5.3%. Now it's 7.7. Now it's 5.45%. Okay,
so it's risen.
All right, but look at what's happened to the BBB minus paper. 7.75 around there when it was issued, and now it's 30%.
Wow!
Tremendous losses in there and gains for the guys who come in now and hold this paper. What's interesting about this is this thing suggests that there will be 80 or 90% losses in this, and all they've been is like in the 12% range. So some guys are seeing a lot of value in here. Let's look at some of the keys to the blow up here now, Bill.
Okay.
Foreclosures and delinquencies have been on the rise quite a bit. That's deteriorated that BBB tranche right there, and really gone up a little bit into the BBB. If housing worsens, these things get worse from here. The big question here are ratings downgrades. If that AAA paper suddenly becomes seen as B paper or even just single A paper, it's going to affect the entire capital structure. So that's what you do. You take a whole bunch of mortgages, you put them in a pot, and you slice them up by losses.
The house of cards came crashing down in 2007, starting with the collapse of 2 Bear Stearns hedge funds in 2007. Bear Stearns was one of the most respected investment banks on Wall Street for decades, and they manage a lot of different projects and hedge funds. In June 2007, their main company had to bail out one of their funds with a cash injection of $1.6 billion to help the fund meet its margin call and avoid liquidation. By July 17th, Bear Stearns reported that one of the funds had lost nearly 90% of its value, while the other one pretty much lost everything. This was the beginning of the end for Bear Stearns, but it was also a sign to the rest of the market that mortgage-backed securities were about to become a serious problem. Throughout the rest of 2007, more people were defaulting on their mortgages, and the securities they were tied to had started to become massive debts on the balance sheets of most of Wall Street. Some firms like Goldman Sachs saw what was happening and pulled out of the market with limited losses, while continuing to sell the mortgages to customers without telling them about what was happening. By early 2008, Bear Stearns was purchased by JP Morgan, but then other banks started reporting huge losses, mostly tied to subprime mortgages. In July of 2008, IndyMac Bank collapsed, which was one of the biggest bank failures in U.S. history. Then everyone started to look at Fannie Mae and Freddie Mac, 2 organizations that were at the center of the mortgage market at the time. These were companies that were privately owned and controlled, but they were created and sponsored by the government. Their purpose was to keep the mortgage market stable and help lower-income families secure mortgages, but they were deep in the subprime market. To prevent them from failing, the government took them over, which they hoped would stabilize the housing market, but it was too late to stop the contagion. People continued to lose their homes and the market continued to spiral. In September, Lehman Brothers, another famous Wall Street bank, declared bankruptcy, which was the largest bankruptcy in U.S. history, at over $600 billion. Yeah, I said 600 billion, not million. And this is when most people really started to pay attention to what was happening in the markets. It wasn't just here in the U.S. either, because these were global financial institutions. And there were similar schemes running in other countries that were falling apart too. After the collapse of Lehman Brothers, the Dow Jones Industrial Average fell more than 500 points in a single day. On September 15th, 2008. This caused a total freeze in the credit markets, which meant there was no liquidity for loans. Many large banks didn't make it through the year, including Washington Mutual and Wachovia. Many of the collapses that happened early in the crisis included some of the government bailouts. In some cases, a loan was facilitated through the Federal Reserve and a partner bank like JP Morgan. And in other cases, the FDIC came in to refund customers, or a business was put into conservatorship, as we saw with Fannie Mae and Freddie Mac. These were all indirect, and it was hard for the average person to realize how they were getting screwed in this process. As the crisis got worse, though, the bailouts became more direct, and people started to get angry. It didn't help. There were bankers working at the Federal Reserve and Treasury Department that were basically handing out bailouts to companies they had direct ties to. On September 16, 2008, the U.S. government decided to rescue an insurance company called AIG with an $85 billion loan to save it from collapsing. Henry Paulson, who was the U.S. Secretary of the Treasury at the time, was involved in deciding who would get the bailouts and who wouldn't. He was also a former employee at Goldman Sachs, which gave him a huge conflict of interest. He allowed Lehman Brothers to go under, which makes sense because they were big competitors of Goldman Sachs. And then he decided to bail out AIG, which also makes sense because they owed Goldman Sachs a ton of money, and they wouldn't be able to pay it if they declared bankruptcy. A month later, in October of 2008, Congress passed a major bailout package called the Troubled Asset Relief Program, or TARP for short. It allowed for $700 billion in taxpayer money to be funneled to the biggest banks in the country in exchange for their worthless mortgage-backed securities. When the dust settled, it was actually revealed that it was more like $7.7 trillion in bailouts. This is probably one of the most unpopular policies in the history of the country, equally hated by the left and the right. The media told us that the bailout saved the economy, but the average person has been worse ever since, and none of the bankers were ever brought to justice, which caused even more anger. The crash and the bailouts had massive political impacts too, both here in the US and around the world. People everywhere lost a lot of trust in both the financial and the political system, as well as the media, who played defense for the banks as long as they could, and tried to blame the crisis on the people who bought the mortgages. This also increased inequality around the world because the global unemployment rate went up, and brought a lot of attention to the growing gap between the rich and the poor. Governments also responded to the crisis horribly by increasing taxes on average citizens, after they watched the richest people in the world get tax-funded bailouts. The economic fallout was a major spark for the Arab Spring, a wave of protests that spread across the Middle East and Northern Africa, leading to revolutions and regime change in Egypt and Tunisia, and civil wars in places like Syria, which are still raging today. Similar protests also erupted in Europe, especially in places like Spain and Greece. Here in the US, massive political movements like the Tea Party and Occupy Wall Street formed in response to the crisis, each representing different sides of the political aisle, but expressing the same basic frustration with them. These movements led to the rise of populism in the US, which was a major factor in the popularity of political candidates like Donald Trump and Bernie Sanders. Two very different candidates that tapped into the economic frustrations of their audiences. I also think it was a factor in why Bitcoin got so popular so fast. Bitcoin wasn't a response to the crash of 2008, but Bitcoiners probably were. Let me explain. Crypto was in development for many years before the Bitcoin white paper was published. I talked about this in my book, Catching Up to Crypto, and in my videos about the cypherpunks. The unpopular bailouts were referenced by Satoshi, but it wasn't Satoshi's main motivation in creating Bitcoin. At the same time, I think that the financial crash and the bailouts got people angry and it motivated them to find solutions to our economic problems. So a lot more people were a lot more likely to understand Bitcoin and get excited about it when they started to hear about it a few years later. If Bitcoin were to launch into a world where the crash of 2008 and the bailouts never happened, I'm not sure that there would have been a receptive core community like there was. The appetite for alternative currencies was a lot stronger in 2012 than it was in 2007, and I think that everything that went down with the housing crisis is a very obvious reason for that change in sentiment. That's all I got. Be blessed. BitBoy out.